Hey, it's Jamie York here, and in this video I'm going to be breaking down when I think the market is coming to a crash. Now, we've gone through a lot in the last few years with Brexit, COVID-19, and then the artificial recession that we're getting hit with right now in a 22% drop. So you'd think that the housing market would reciprocate that and be in a massive drop right now, but actually it's not the case. So will it come? I think absolutely yes. It's often delayed, and before we look at when that's going to happen, we need to look at the main contributors to the factors. So first of all, the pandemic. Okay, now obviously there's loads of outcomes for that and secondary outcomes which I'll be going through, but the main part of this is the fact that there's a pandemic in the first place, and so people's concentrations are going in different areas. So there's not many people in the middle of a pandemic that's thinking, oh, when's the next house I'm going to buy? Or, oh, what's the next investment I'm going to make? With the borderline scaremongering that's sort of going on, people are thinking, am I going to catch it? Am I going to die from it? It's a bit morose, but that's what people's getting fed into people's minds. So, you know, there's a big reason I don't like watching the news, and it's the overarching negativity is why I don't like getting engrossed into that. So that's one major factor of it, is the concentration levels or the priorities in people's lives change. So people in the open market, and I don't just mean from an investment, what you have to understand is the open market, people, first-time buyers, etc., often dictates most of the movement, not really investors. And so if the open market isn't really concentrating on, oh, I'm going to buy my next home, or where are we going to do this and where are we going to do that, actually they're thinking we need to stay inside, we need to stay safe, obviously that's going to have a massive impact. The second big thing impacting this is the closed market theory. So as I just said, a majority of the market is impacted by the open market buyers, okay, first-time buyers, downsizers, upsizers, etc. And what we've just had for the last 3 or 4 months is a closed market. And I've used this analogy before, but it's like Black Friday, where you're trying to get in, I'm not going to let you in, and then you open it, and obviously you get a fluctuation of people buying and selling property on the open market. The downside of that is when that initial surge of demand and supply is diminished, what then happens is the housing market starts to get impacted, implode a little, and go into a mini recession. So that's not actually a downside, because some people call a recession a correction, and often this is a correction of the market. We're not actually going through this. I expect that's going to happen in the next few months, so I would expect a mini correction in the market of October, November 2020. That's going to be the first correction. The next part of this is looking at the government functions and what they've put in. So you've got the B bills, the C bills, you've got the grants, you've got furlough, and it's looking at the economy and how it gets affected through that. So why does that matter? Well, B bills needs to start getting repaid in 12 months from when it was issued, and people are going to get hit by that. So that's something that I'm factoring in. So when was it issued? Most people are getting it within the first couple of months. That's when businesses are going to have to start paying it on top of everything, and obviously the impact of having that 50 grand. Did the 50 grand counter what most businesses lost during that time? I don't know for a fact, but I very much doubt it. But the stimulus starts running out, so we've got furlough coming to an end September, October. I think we're going to see a load of redundancies. We're already seeing it a lot. We have had more applications in the last couple of months than we have in the last couple of years, from people proactively reaching out saying they're getting made redundant. Is there a spot for them here? Can we help them out? And as that stimulus stops, that's going to start coming through, and I think we're going to see a lot of businesses shutting down or starting to shut down this side of Christmas. What we're also going to see next year is another fluctuation of that and more redundancies, I think, in February, March, where the additional grants run out. So right now we've got grants for apprentices, which is helping towards households, obviously, by people getting that experience. And there's a furlough bonus of £1,000, I believe it is, in January for if you kept them on. Are many people going to keep furloughed staff on for that duration for £1,000? I don't know, but I think it will sway some people's decisions. And even if we said 25% of people that would make them redundant, keep them on, so 1 in 4 people because of that, then it's likely that in February, March, we're going to see that. So then we've got the delay factor. Okay, so this is when we need to start taking it in. So if people get made redundant today, does that mean they're automatically selling their house? No. It means that we're probably going to see more people putting properties on the market during that time, but we're going to see probably a 3 to 6 month delay before this is massively impacted. So again, if we're in March, we've got April, May, June, July, August, September. So we're up to September next year. The next part we're going to be looking at is risk analysis. And I don't actually mean this as an investor or a buyer, because most buyers aren't actually looking through risk analysis as part of their purchase decision, because often they're deciding with their heart rather than their head, which I'm not saying is a bad thing, but obviously from a financial point of view, it can be. I'm talking about the risk analysis of a lender. So when there's uncertainty in a market, it increases the risk. And if people are increasing the risk, reward has to directly reflect that. And I'm not saying like, oh, you're going to make more money. It has to directly reflect that. So you have to increase your rates. Or if I'm loaning money to people in property, my average is about 16%, but I'll probably increase it to 20 to 22% to factor in my risk of an equity investment. The debt portion, i.e. the mortgages, are going to do the same. So what I think we're going to be seeing over the next 6 to 12 months is an increased need for a deposit. Let's say by summer next year, they're going to be asking for a higher deposit within a property. And I think they're going to be increasing their mortgage rates. I mean, we're at an all-time low anyway, so don't be shocked when interest rates start going out. It kind of can't go any lower. What is it? Base rate is at 0.25 or 0.25%. There's talks of negative interest rates at the moment to help with investment, so people aren't saving money, they're investing it or spending it, which is going to help the economy, which actually would be incredibly helpful for people. But what it also means on the flip side is if that risk is there, they're going to expect more back. So what then happens is, as an investor, what ends up happening is, well, let's start with open market apps actually. So higher deposits. Most people don't have 20% deposit in their bank, but I'll just put in 10. Most people get to 10% and then invest it or spend it or go for it. So if you think about if you've purchased your first property, or maybe you're on the way to purchase your first property, I can near guarantee you are saving for that level and then going to buy. You're not going, I need 10%, so I'm going to get to 15 to 20. That's just not how human behavior works often. If you are one of those people, congratulations, you're going against the norm. It's probably quite a smart move to protect yourself like that. So if they end up needing a higher deposit, what it's going to do is delay a load of people, or they're going to need to downsize or reduce their expectations of what they're able to purchase in the market. From an investor's point of view, one of the key factors isn't so much yield, it's return on capital employed, or ROCE. Now what that means is the more money that's left in a deal, the lower our return on capital, i.e. the net rent that we're getting against a property. So let's say I want a minimum of 15% return on capital, and let's say normally I'd leave in £20,000. What I would need to hit 15% return on capital is £3,000 per annum. 3,000 over 20,000 is 15, or if you half it, 1,500 over 10,000 is 15%. Okay. However, if because of that higher deposit, it now meant I'm going to leave in 30,000, suddenly my £3,000 is now only making me 10% return on capital employed. Whilst it's still a great investment comparing it to the banks right now, is it anywhere near my minimum criteria? No. What does that mean? Well, it either means I need to suck it up and just accept I'm going to get a lower ROCE or return on capital employed, or what it likely means is I'm going to start offering lower amounts of money. So again, getting into buying psychology here and understanding when this is I'm going to go through time frames a bit towards the end of this video, but understanding how we're getting into that buying psychology. The next part is probably something most people aren't thinking too much about, is serviced accommodation or Airbnb or booking.com renters. There has been a massive influx or trend or fad, whatever you want to call it, over the last couple of years, plowing into the service accommodation market. So much so that the hotels have been getting involved trying to stop this from happening because it's affecting the rates they're able to charge and the demand that they've got. But the thing is, what most people haven't factored in when they've taken on a service accommodation is, as I've said in past videos and I will in future videos, everyone seems to focus on when something goes really well. Not many people prepare to have a secondary or tertiary exit with their investment. So they purchased something or took something on the basis that would make a great Airbnb, service accommodation or booking.com rental where they're going to make £1,000 a month. And then they realize actually the market shut down. Unless they've got a contractor market, if they're relying on tourism in any way, again, they're not going to fill up their spaces. They're going to end up either needing to give back the apartments to the landlord or sell the property. And I think we're going to see a massive fluctuation of that. Now, why is that important? It does two things that's really important. And again, I'm talking about macroeconomics here, which is a little bit geeky, but it's so important, and not many people talk about this stuff. And I think it's crazy if you're trying to build a successful portfolio. What it does is two things. Number one, there is an increased supply to the marketplace. Okay, and if demand doesn't increase with that, which it unlikely will because of the uncertainty in the market, there's now more properties for sale than people wanting to buy them, which means there's going to be less offers, which means there's less competition, which means people are going to get better deals in that. But that is going to trigger not a recession, but certainly a collapse of the housing market. The other thing it does is if they don't need to sell them, let's say people have got their secondary exit to it. Now think about this, just follow the logical path here. If you have thought of your secondary exit and you're no longer going to do it as serviced accommodation, what are you going to do with it? Buy to let. Okay, really, if you're not going to sell it, it's the only way to go, unless it's got option for HMOs, and that's a conversation for another time. Most people are going to do buy to let. What does that mean? In the next 6 months-ish, there's going to be more buy-to-let stock available on the rental market. Supply and demand again. If there's more supply of rental properties now for the people looking for them, and my general advice to renters, maybe not a good idea to give this advice, is if you're at the end of your contract, maybe you can renegotiate your terms or go and look for another property, because you're probably going to be able to negotiate a better rate in the next year or so, or 6 months to 12 months. Again, what does that do? Well, as an investor, it's reducing our return, and the deposits are likely to go up, but even if they don't, it means that our return on capital is dropping, which means we have to lower our offers. Again, you see all of these things at play. It's the deposits have gone up, or likely to go up in a risk assessment. The interest rates are going to go up, and the returns are going to go down. That really does affect. So suddenly you're putting 30k in and getting 3k when you were getting 20k and 3k, but now you're putting 30k and it's dropping to £2,500. How does that look? Well, now you're looking at a 8% return or a 7 point something percent return. And so these factors come in. So that's a really big one that most people won't think about, is the Airbnbers or the booking.com service accommodationers that are going to have a tertiary effect on the supply and demand of both the rental market and the properties coming on the market. So all of this is impacting not only the macro economy, but also your local economy as well, and buyers' mentality. And ultimately, behavioral psychology plays a part in every investment sector, whether it's stocks or property. But ultimately, we're going to have a lot of turmoil coming in. So we've gone through closed market, the pandemic, buyers' mentality, Airbnbers, the impact to the rental market, and a load more in this video. And I know it can be quite a lot and hit at once, so feel free to go back and watch this video again as many times as you need, and let me know in the comments if there's anything you'd like me to expand on in future videos. There's one thing I've not really boxed off, and that's when will it happen. As I said, I think we're going to have a minor correction probably about October, November time, certainly this side of Christmas, where the hot market starts to cool down a little. And I think we're going to see another slight correction probably around March, April next year. And I think towards the end of next year, coming out of summer, I really think we're going to see a bigger correction. So what advice would I give around this? As I've said in previous videos and will in the future, property is not something you wait to buy. You buy property and wait. However, be strategic and have your war chest, have a pot of money ready to go, because ultimately the cash in your bank is going to give you power. I hope you found this as helpful as possible as you're going out there in property investment in the new age, if you like. If you found this helpful, please make sure to subscribe, show your support, and I'll see you in the next videos where I'm giving you a load more value around property investment and how to scale your property portfolio both safely and effectively to make sure you're monetizing in the best way. And if you like this video in particular, make sure to smash the like button and make sure to leave in the comments what you're finding complicated right now, what you need help on, and I'll make sure to reply to every comment. I'll see you in the next video.